All right. Oh, we got a bunch of people showed up on time. I love it. Yeah, so we are going to get started, everyone. Hello, hello. Hi, Carol, Tom, Brian, Chris, everyone, Joe. Thanks for showing up. If everyone can just keep yourselves muted as we're going to go through the presentation. If you do have questions, if you want to type anything, let us know, whatever, give us feedback. We got a chat. You can type something in the chat, which we'll keep an eye on. And then we also have a Q&A. If you have questions that you just want to keep anonymous, right? You just, whatever you want to type in the Q&A, we'll keep an eye on both. And then we will get to those at the end, just because we're going to go through a ton of information and we will probably answer a lot of the questions along the way. So appreciate everyone showing up. I am going to kick things off. And then luckily, it turns out
Uh,
today I don't feel 100%. So Josh, our guy, Josh Ford with Nationwide is going to do most of the talking. So he will take over from there. But as most of you know, today we are going to be talking on tax advantage planning for business owners. Really, we are targeting at two business owners, but it's going to be a really great 30 minutes for anyone, even wanting to learn a little more about long term care. Josh has a lot of good information he's going to run through. We're going to have a few different topics on tax advantage planning. This one, we're going to focus on long term care. So the speakers for today, obviously we have myself. I'm Dylan Hallahan. For those of you who don't know me, I am the director of this department of the Long-Term Care Life and Disability Department in Manual Insurance. We have JT Crosby as well. He's our executive director of sales and risk management at Emmanuel Insurance as well. And then we have Josh Ford, our guy over at Nationwide. He is our expert, one of our product experts, and I would say industry expert. Honestly, I mean, wealth of knowledge on this topic, and he specifically is with Nationwide, one of our top carriers. Although we have many, we really we love Nationwide and some of the products that they provide. So with that, I am just going to get right into it. I'm going to let Josh take it over. Josh, if you want to steal the screen from me, and you can take it from here. And again, thank you so much, everyone, for showing up, and we'll get things rolling. Go ahead, Josh.
If I could get myself unmuted, I've done enough of these things to take myself off of mute.
Yeah,
But
right.
can you see the screen okay?
Yeah, we're all good.
All right, awesome. Well, as always, I appreciate the opportunity, Dylan and JT, and thanks for everyone for joining us. As Dylan mentioned, I am Joshua Ford, regional wholesaler here at Nationwide, covering the long-term care suite of products that we have. And I'm local to a lot of you all here in Philadelphia, covering the Northeast. But I'm happy here to be bringing you this topic around tax incentives for business owners. This is certainly one of the more underserved markets when it comes to long-term care. And it's a great opportunity for your business owners to purchase long-term care potentially on themselves and also reward some of their key employees. The question that I have, and it's a very simple one when I generally have this presentation, is do your business owner clients want to keep their best employees around? It's a really simple question, and the answer is always yes, right? It's almost rudimentary, the question. But how can we keep our top employees at the business? One of the ways is to, of course, increase compensation. Everyone's looking at different salary options. One of the other options is to offer non-salary benefits that just can't be sought after in other places. Long-term care is one of those potential benefits. And if you're dealing with a small business who is looking to reward key employees, they may actually have the ability to purchase long-term care on their key executives and have it be completely deductible to the business. So if you're in that market working with businesses, small, large, C Corp, S Corp, LLCs, what we'll talk through today are some opportunities and some tactics that you can use to have them purchase long-term care and reward, retain, and attract key talent within their business. So I'll keep today's commentary to about 10, maybe 15 minutes. We'll be going through a ton of information, as Dylan mentioned, but I absolutely encourage you to utilize the chat and the Q&A feature. We'll definitely get to those at the end of the presentation, and I don't want you to forget, if you're anything like me, that good question is going to escape you in about 30 seconds. We don't want that to happen. So in order to have this conversation around tax incentives for businesses, let's first talk about the types of products that this is going to be applicable for. And those products are the hybrid long-term care contracts. If you've heard hybrid, asset-based, combination long-term care policies, those are the ones that we're talking about. And we're talking about the ones that specifically separate out the client's premiums between the life insurance part of the contract and then the long-term care part of the contract. That's a really important foundational piece to understand because with a product like what Nationwide offers, which is Care Matters, when clients pay their premiums or if a business pays the premium, we actually separate that out into the life insurance portion and then the long-term care portion. As we know, typically we can't take deductions on life insurance premiums, but because the LTC riders are a separate stream, those are actually seen as health and medical expenses, which opens up the possibilities for what can and cannot be deducted. There are some products out there in the marketplace that don't separate out the premiums. A client pays into the life insurance contract only. Those types of products are really off the table for the conversation that we're having today. So it is worthwhile to take a look at the product that you're working with and ensure that they have what we call separately identifiable premiums. If they don't have that, they won't receive the benefits that we're talking about today. But again, Nationwide's products, Care Matters 2 and Care Matters Together, our joint long-term care platform, do have those separately identifiable premiums. And when we think about the value of having the separately identifiable premiums, because those LTC costs are isolated and paid for separately, it's seen as a health and medical expense. And if you have a business involved, you can actually deduct those above the line. And that's an important key concept because if you or I or any client is looking to purchase long-term care on their own, if a business is not involved, the only way they can deduct those health and medical expenses is if they spend at least 7.5% of their adjusted gross income on other health and medical expenses first. Then they could take some sort of deduction. Really quick example, if you have a client who makes 100 grand a year, they would have to spend $7,500 on health and medical expenses before any sort of deductions could take place. But because this conversation involves the business, that deduction can take place above the line. So there's no 7.5% qualifier. Same client who has $100,000 of adjusted gross income, if the business is paying for the policy, it gets that deduction without having to spend $7,500 out of pocket first. So a really important piece is that above the line deductions. All your business owners love that above the line deduction, and we can do that with long-term care. So those are really two foundational points of this conversation. You have to understand the type of product you're working with, making sure you're working with a product that has separately identifiable premiums. Second piece is that long-term care portion of the contract can be deducted above the line because the business is involved. So with that foundational understanding set, we'll talk through really the two big opportunities. We'll talk about W-2 employees and C Corp owners. Then we'll talk about pass-through entities, your S Corps, your LLCs, what we can do to encourage them to purchase long-term care. So we'll start here with C Corp owners. If you have a C Corp owner or a W-2 employee of any corporate type, what can happen is that corporation can purchase long-term care on that key employee. The business deducts the entire premium at the corporate level. And remember, the premium is broken down. So that life insurance part of the premium is treated as compensation. So the employee is going to be responsible for the income tax liability of that. The long-term care riders, again, is deducted by the business, but because it's a health and medical expense, it's not realized income to the employee. So the employee can get the full benefit of the premium being paid for by their employer, but their only responsibility is the income tax liability on that life insurance part of the premiums. I'll give you another example. So if a client is a chief marketing officer for a business and the business is going to pay for long-term care for them, let's say they're going to pay $20,000 a year for 5 years to make a $100,000 premium. $10,000 of that 20,000 premium could be life insurance premium. 10,000 could be LTC riders. So following the structure that we just talked through, the business deducts the full 20,000. The employee is going to be bonused out the 10,000 to pay for their life insurance premiums. The LTC riders are not realized income. Those are not counted in the taxable income for that client. So this is a great way to offer an alternative benefit and have it be cost effective for the employee. These types of arrangements are not bound by ERISA. You don't have to offer it to a certain class of individuals. You can simply choose whoever those key W-2 employees or C Corp owners are and offer this to them on a voluntary basis. We typically call these, and I always try to refrain from saying this, but these are the banana cases because they come in bunches. Because what you'll notice is that if you have a conversation with the chief marketer, then you have a conversation with the head of HR, and then you have a conversation with another key executive, and then we include their spouses because spouses can be included on these arrangements. One conversation can dovetail into 6 separate opportunities for long-term care. The question that I typically ask when we have these conversations with the business owners or those key influencers at the business is, would $10,000 or $20,000 a year in premiums or in bonus change your life? These are highly compensated individuals making $300,000, $400,000, $500,000 a year. An additional 10, 20 grand may not make a huge impact on their livelihoods. But if you actually use those premiums to pay for LTC, that $1 million of long-term care that's going to be purchased is going to make a tremendous difference in their lifestyle, and the business gets to deduct it. So it is a much more attractive way to show long-term care. So again, if you're dealing with C Corp owners or W-2 employees of any corporate entity, the business can pay for the policies. They get to deduct the full premiums. The only liability that the employee has is the taxation on the bonus part of the premiums. One other important piece of this before we move on to the LLCs is that these policies are still individually owned and individually underwritten, and that can act to the benefit of the employees and the employer. So because these policies are still owned by the employees, 15, 20 years down the road, the employer is not on the hook for paying claims. The policies are also completely portable. So if the employee retires at 65 with this policy, they move to Florida, the policy goes with them, the business is no longer involved. The business is just there as the payor in those situations. So if you're dealing with these types of situations, W-2 employees, C Corp owners, absolutely, this is a great arrangement and an opportunity to offer long-term care to those businesses. Let's talk about now let me keep moving on, pass-through entities. So if you're dealing with a pass-through entity, and this may be where a lot of your businesses fall, LLCs, any sort of situation like that, those business owners can pay for long-term care from their business. The life insurance part of the premium is not able to be deducted, but those LTC riders can actually be deducted above the line. So looking at the chart on the screen here, these are actually the deductibility limits on those LTC riders in each year. So if you're dealing with, let's say, a 57-year-old business owner who wants to purchase long-term care on himself and or his spouse, what he can do is pay the full premiums and then take a deduction of up to $1,800 in this tax year from those long-term care rider costs. Those deductions can be taken every single year that you're paying premiums. So for this gentleman in my example, who's 57 years old, every year he's going to take about an $1,800 deduction until he's 61. And then you'll notice that the deductibility limits actually ratchet up at age 61. So at age 61, it jumps up to about $4,800 in this tax year. And the overall opportunity to deduct the premiums is pretty large. This is a great way, especially if you have clients who have a side
Well,
business. Maybe
yeah,
they
the
do
reason I asked
landscaping
you
on
for
the
that comment
side,
today is
or maybe they
casting.
have an opportunity to uh, have some sort of passive business that they aren't necessarily doing every day, but they are the owner. This is a great opportunity to get them into the long-term care conversation and offer them an annual deduction. I'll give you a quick example of a case that I worked on where we actually had a client who purchased long-term care and his wife owned a granola business. So what we had was her purchase the long-term care policies on both of them. She paid the premiums, and each of them get that deduction of the 4810 off those long-term care rider costs. So if you are actively in the market of small businesses, S corps, LLCs, this is a great way to get them into long-term care and get them that guaranteed deduction every single year. And if you include a spouse or an adult dependent that qualifies, those individuals also get that same deductibility. So I know we just talked about a lot. I'll give you a quick recap and then I'll touch on the last piece of the conversation here. So again, if you're dealing with a C Corp owner or a W-2 employee of any corporate structure, and I'll just jump back a screen, the business can pay the full premiums, deduct the full premiums, but the only thing that the employee is responsible for is the income tax liability on that life insurance part of the premium. If you're dealing with an S Corp LLC pass-through entity, those individuals pay the full premiums from the business account and they can take an above the line deduction on the LTC riders up to the age-based limits as laid out in this chart. So really, regardless of the individual that you're working with, it's first of all important to ask, do they have a side business or are they a business owner? And if so, see where they fall in the hierarchy and see if we can offer them some sort of tax deduction for purchasing long-term care. Last but not least, and this is a really important part of the conversation, is inflation protection. So as we talked about, when you have the premiums paid to Nationwide, it's separated between life insurance and then long-term care riders. What we want to do in a lot of these situations, because the LTC riders are the portion of the policy that are not included as income, we want to drive up those LTC rider costs as much as we can. And how do we do that? We add inflation. So this chart on the screen shows you how inflation can shift the balance inside of a policy. The example is a 55-year-old executive at a C Corp. The business is going to pay $20,000 a year for 5 years. So if you're looking at the column that says no inflation, what you'd notice, if we just go down to the green here, is of that $20,000 premium, $17,000 is life insurance. So that's the portion that's bonus to him. $3,000 is LTC riders. So the business pays the $20,000, the $17,000 bonus paid, $3,000 is included in the health insurance, not going to be counted as income. Good conversation. However, if we switch to a 3% compound inflation rider, you see that the balance shifts from being life insurance heavy to being a little bit more LTC rider heavy. That bonus, that life insurance premium goes from 17 grand down to 12.4, which drives up the LTC riders to about 7,600. So the amount of income that the employee is responsible for goes down quite a bit. If we were to add 5% compound inflation, that becomes even sweeter because you actually see that life insurance premium that started at $17,000 with no inflation actually go all the way down to $7,800. LTC riders go up to about 12,200. That 7,800 is the amount that's bonused. The 12.2 is the amount that's not bonus, that's treated as part of the health plan. And what you see is that adding inflation, again, lowers that income tax liability to the individual, drives up the amount of pure deduction for both the business and the employee. So I encourage you, as you have these conversations, as we help you illustrate these policies, we will add the highest amount of inflation that makes sense because it actually makes it a more attractive conversation for the employees to opt into this program. So with that, that really concludes all the content I had here for today. I'll give you one quick recap as we come up on time. But if you're dealing with business owners, W-2, C Corp, LLC, pass-through, whatever the case may be, long-term care can be an attractive way to retain the talent that they have in the business, reward those key executives, and maybe even purchase LTC for themselves. If you deal with a carrier like Nationwide, there are some very attractive tax benefits to purchasing long-term care through the business. And I challenge you all to just think about one business owner who you have not had that long-term care conversation with. Reach out to Dylan and allow him to help you illustrate a meaningful way to get long-term care that could be tax deductible. So with that, I know I went a couple minutes over here today, so I will stop sharing and turn it back over to Dylan for any question and commentary.
No, you were perfect, Josh. No,
Great job.
that was perfect. Yeah, I think, and I know that was a lot of information there, but all really, really great information. If anyone has questions, type them in now. And I think just to, and I'll let JT speak briefly as well, but I think just to give you guys, everyone here who doesn't know, an overall sense as to manual insurance and how we operate and who we work with this is a very large specialty into what we dive into when we meet with our clients. We really focus very heavily in working with, number one, business owners, but then in the tax advantage planning and the tax planning in the sense of using these insurance policies for that purpose. So I think we definitely hit on those, and Josh went through a lot of information on that. But then it's also you're adding benefit not only to yourself as a business owner, if you are a business owner, to your clients who may be business owners, but also their employees. Yeah, it's a great plan to take advantage of, or at least consider. And we always recommend that, hey, if you want to learn more, if you want to explore those options that might be available to you, we're here at Emmanuel Insurance for you. Josh, I know he won't like me to say it, but we love Care Matters, right? But we do have options to other carriers. We're an independent broker, so it's not necessarily, and Josh knows this as well. Nationwide is not a one size fits all, right? And we are not a one size fits all shop. So if we are able to actively advise clients and put them in the right policy, the right strategies that make sense for them. With that, JT, I don't know if you have anything else to add to that.
Yeah. Well, we do have a question in the Q&A, and this is for Josh. If there is an S corp that has W-2 employees, can the S corp write off all of the premiums because it's a W-2 employee, or does it have to be a C corp with W-2 employees? I think is what they're asking.
Good question. Good point of distinction. So the W-2 employees can belong to any corporate structure. So the W-2 employees of an S corp or of an LLC, the business could deduct the full premiums in the first way we talked about. The owner, however, is treated in the second way that we talked about, where they only get a deduction on the LTC riders. So W-2 employees get the best deal of any corporate structure.
Fantastic.
Josh, I'm actually going to propose a question to you because we get it often, right? Especially when we're talking tax benefits, and we're talking tax benefits mainly geared towards the business owners. But let's say we are dealing with a C corporation or whatever, right? And they're deducting those premiums that they are paying for this policy. Does that in turn affect the benefits that are paid to those employees, the long-term care benefits?
Fortunately, it does not. So they're getting some tax benefit on the premiums, but the policies are still tax qualified. So all of those long-term care and death benefit dollars that come out are still going to be tax-free.
Which is very unique. Typically you're getting taxed somewhere, right? Either the business owner's taking advantage of those tax deductibles, and then the employee's paying for it down the road, right? They're being taxed on those benefits, which is not the case with these qualified long-term care policies, which is very unique.
I have one more question from you personally. So I know with the Nationwide Care Matters product, you have that ability to have a product like which I own, which is a joint policy that's insuring myself and my partner at the same time on the same policy. And me being a W-2 employee, and does it matter if my partner is a W-2 employee or not? Would my company still be able to deduct the whole thing?
Yes. The way that works administratively is that life insurance portion, they would just bonus you enough to cover the full life insurance premium for both of you. And because that is your partner, is treated as a spousal health plan, so they can still deduct the full riders for her.
Okay. And so that would be the same if I had my own policy and she had her own policy, even if she didn't work for the same company?
Correct.
Okay,
Correct.
great. That's amazing.
Mm-hmm. I'd say I'll give you one example of a case we did like that. We had a big bank up in the state of Maine, a regional bank, I should call it. And we did just that. We wrote a policy on about 7 executives and 3 of the upper executive spouses. And we did just that. So I'd say small regional banks, small, local pizza chains, law firms, doctors' practices. That's really where we see this type of planning shine.
Excellent.
Interesting.
Well, I'll open it up to the group. Is there anyone else that has any questions, comments?
Yeah, even if you guys want to unmute yourselves, you should be able to. But we only got a couple minutes left.
I think Dylan, JT, while we wait for the question, I'll drive home one more point if I can share my screen. I think this will wrap up the
Yes.
conversation pretty nicely.
Yeah.
Great.
One of the things that I alluded to in the beginning of our conversation was if you have these highly compensated individuals, how much would a cash bonus make a difference in their lives versus an LTC policy as their bonus? And this screen I talked about earlier does a good job of illustrating that, especially if you look at that 5% compound sign. This is a person who's 55, highly compensated. A $20,000 bonus may not make a big difference in his life from day to day if he's already making 3, 4, 500 grand. But a $1.1 million long-term care policy that pays out $13,600 a month, that has a profound impact for him. And let's say if we included his spouse, that's $2 million of long-term care. Their total income tax liability would only be about $78,000 to get $2.2 million. So that conversation is one that when you see the numbers drives it home even more so. And again, just ask yourself the question, would the employee rather this $20,000 that they're going to be taxed on or get a $1.1 million long-term care policy that's going to be tax-free on the back end? That's the value proposition of this type of planning for those business owners and their key executives.
Excellent.
I just wanted to talk through that.
That's awesome. That's awesome.
Yeah. Well,
So
go ahead. I was just going to say, this year for 2025, we've been trying to bring information to all of you, even to like people that we compete with. It's so important that we're educating ourselves and being able to share information, learn from each other. And we're going to continue to have one a month, and we're mixing up the topics between LTC, life insurance, disability, all different kinds of strategies that we're being able to utilize so that we can help our clients, the business owners, their employees, and make us more powerful and an extension of the business for the people that we're working with. So, with that, I thank you all for joining. There will be a recording, and it will be posted on the Emmanuel YouTube page. It usually takes about 48 hours to get it up. But if this is something that you found beneficial and you want to share it with any friends, family, our colleagues, clients, please feel free to do so. All right. Have a great day, everyone. Thanks for joining.
thank you so much, everyone.